Hello, welcome to my channel today. This is King's Tutor. The first time of joining us, thank you for clicking to this. Ensure you like, comment, share, and subscribe to this channel. Okay. Now today we want to continue on our topic on corporate finance. Okay, we have seen the net present value, which is the discounted cash flow. Okay, technique. If you have not seen that video, I'll drop it up here. Ensure you watch that. We have diverse videos on that. Now today we want to see the internal rate of return. Okay, the internal rate of return also it's one of the discounted cash flow technique. Okay, now what is the internal rate of return, which is acronym as IRR? Now the internal rate of return is a discount rate that gives a zero NPV, a discount rate that gives a zero net present value. Okay, so it is a discount rate that equates the initial cash flow to the sum of discounted cash flow. Okay, I equate it to become zero. It is also known as what we call the break-even rate of return. Okay, now what the IRR does is to equate the sum of discounted cash flow to make it to equate the project initial cash flow, initial capital. Okay, such that when you subtract them together, it gives you what? Zero NPV. Okay, so that is what the internal rate of return. So mathematically, the internal rate of return is given as we have our net cash flow over 1 plus IRR raised to power n minus our initial capital outlay. Okay, our initial capital outlay. Now this should equate 0. Okay, so that's the formula for the internal rate of return. Okay, so now once we are given a question as regards the internal rate of return, what we should do is to ensure that we get a rate that once we apply it through our normal method, now when we apply it and we subtract it from the discounted cash flow, it should give us a zero NPV. Okay, so that is what the internal rate of return. Now we have different method of applying this. Now the first one is what we call the try and error method. The try and error method is just looking for different rates, trying different rates at different time to ensure that once you try it and you subtract the discounted cash flow from the initial capital, it should give you 0. Now if it doesn't give you, you try another rate. For instance, if you use a particular amount and you have a negative value, you try another one to use until you get to 0. Now that can be very and that can be very stressful. We have another one called the interpolating method. And the interpolating method ensures that you use a first rate, and once you use a first rate, if you have, for instance, a positive NPV, now you will try another higher rate than the previous one, and the higher rate will give you a negative NPV. Then you interpolate. Now that interpolation will not give you that rate of return that will give a 0 NPV. Or if there is a financial calculator, that is also possible. Okay, so what we are going to see in this video is the interpolation method. Now let me give the interpolation method. After we have seen the two NPVs, we'll have something like this: A plus, we have A over A plus B times B minus A. Now where A equals the lower discount rate and B equals the higher discount rate, capital letter A equals the positive NPV with lower discount rate, while capital letter B equals the negative NPV with higher discount rate. Now, in order to use this, call this interpolating method, in order to use this, Now, once you're given a question and they're asking us to find the internal rate of return, now we're going to use first a particular rate. If it is given a question, fine. If it is not given, you use a particular rate now and use through the MPV method. Now, once we use a particular rate, let's say if we try 10%, 10% first, and the 10% gives us a positive NPV at the end. Let's say it gives us 3,000 positive. Now, it means that we are going to try a higher rate in order to have a negative MPV. So we are going to try a higher rate than this. Let's say 20%. And that 20% now can give us a negative MPV. Let's say the negative MPV can either be 1.5 negative. So at this situation now, once you have something like this, the second one should be negative. If you try 20% and it's still giving you positive, you should try a higher rate again until you have a negative MPV. Now, how can you have a negative MPV? It is when the initial capital outlay is less than the sum of discounted cash flow. So you can have a negative MPV. And once you have something like this, it means you can now apply this formula to get the IRR. So it means that this 10% becomes lower discount rate, which is A. You can use any variable. I want to use this. There are some that use R. Okay, so A becomes a lower discount rate, which is 10%. Now, while B is higher discount rate, which is what? 20. While capital letter A is the positive MPV, which is the answer you got here, positive MPV. While capital letter B is a negative MPV with higher discount, which is this. So once you put in this formula and you solve that, it gives you the rate that will become the internal rate of return, such that, and that rate might be in between 10 and 20, because with 10 it gave us a positive, with 20 it gives us a negative. So in between them will give you the rate such that when you apply it, probably using a financial calculator, it will give us a 0 NPV. Okay, so we're going to see a practical question on how to use this to solve. Okay, so don't go anywhere. Ensure you like this video. Please ensure you like, comment so far where you're watching us from. Okay, thank you. Let's see the question. Now let's see this question. Now it says the capital cost of a project which will be incurred at the commencement of the project is 15,000. That is the initial capital is 15,000. Now they said the projected annual cash flows are given as year 1, 4,000, year 2, 4,500, year 3, 4,800, year 4, 4,500, year 5, 6,000. Now the projected life is 5 years. Okay, it is 5 years for the project. Okay, so now we're asked to calculate the IRR. So the internal rate of return that will give a 0 NPV. So like I said, using the interpolated method, we're going to use two rates. Now listen, there are some time in a question they might not give you the rate, so you have to generate the rate, the first rate. So once you generate the first rate and it's giving you a positive NPV, so you have to take another rate, the higher one, to ensure it gives a negative NPV before you interpolate using the formula we have seen. Okay, but if you start probably using a particular rate, it gave you a negative NPV. It means you have to reduce it to get a positive NPV. Okay, there are some questions in which they will give you both the two rates. You use that, but once they are silent, you can change a new rate. Okay, so in this now, I want to solve this. So let's try. I want to try a rate. We're not giving any rate, so I want to try 18%. The first one, 18%. So write down the cash flows. Now the 0 is the initial cash flow, which is 15,000. While year 1 is 4,000, year 2 is 4,500, year 3 is 4,800, year 4 is 4,500, and year 5 is 6,000. Okay, so we want to get our discount rate. Now I've taught us how to get the discount rate in our previous video, which is the NPV. Please, if you have not seen that, how to get it, check up here or check in my description. Search for what a net present value. You will see that. Okay, so let's get the discount rate. I've done the discount rate already at 18%. So let me just give an overview. If you're punching our calculator, it will be 0.18, which is 18% plus 1, that is 1.18 raised to the power of, now depending on the number of year, if it's the first one, it becomes raised to the power of minus 1, 1.8. For the second year, it becomes raised to the power of minus 2, like that. Okay, so ensure you check that video. So for the year 0, the first one becomes 1, always 1. So 15,000 times this will give us 15,000. Okay, so for the first one is 0.847. For the second year is 0.718. Third year is 0.608. Fourth is 0.515. And the sixth is 0.436. That's the discount rate. Now to get the present value, it will not be the cash flow multiplied by the discount rate. So it will not be 4,000 multiplied by 0.847 will give us 3388. The second one will be 45 multiplied by 0.718 will give us 3213. The third one, 48 multiplied by 0.608 will give us 2918.4. Why? The fourth one, 45 times 0.515 to give us 2317.5. Why? The fifth one, 6,000 times 0.436, it is 2616. Okay, so nice, we get the MPV. And once we add this and deduct it from 15,000, we're going to get 529 as negative. Okay, it means that everything here is greater than what initial capital outlay. Okay, so we have 15,000. So it will have 15,000. So that becomes our net present value. Okay, so it means that the present value, that's the initial capital outlay, is greater than every amount here. So that is why it's giving us what? A negative MPV, meaning that the sum of discounted cash flow is less than the initial capital outlay. Okay, so that's the first one. Now you see, we've gotten a negative MPV at 18%. So the next thing now is to try and get a positive MPV. Now, how do we get a positive MPV? You reduce the rate, because a higher rate gave us negative. So we're going to reduce the rate so that we can have a positive MPV. Okay, so if you're trying it, probably any question, the first one, if the first one gave you a positive MPV, you're going to increase the rate to have a negative MPV. So since we have 18% at negative, now let's try 16%. We have reduced it. So the cash flow remains the same as is 15,000 initial capital. We have 4,000 here, 4,000. We have 4,500. We have 4,800. We have 4,500. And we have 6,000. Okay, so the discount rate also we have done is 1.00. This is 0.862, and this is 0.743. This is 0.641. This is 0.553, and this is 0.477. Okay, so if we multiply 15,000 times 1, will give us 15,000 as the present value. So 4,000 times 0.862 will give us 3448. And 45 times this will give us 3344. Now 48 times 0.641 will give us 3077. And 45 times 0.553 will give us 2489. And 6,000 times 0.477 will give us 2856. Okay, so we're going to add, and once we add and deduct 15,000 from it, it will give us 214 as the net present value. The net present value. So this amount now is a positive because the sum of discounted cash flow is greater than the initial capital outlay. So you see, a lower discount rate gave a positive MPV, while a higher rate gave a negative MPV. So it means that the IRR that will give a zero MPV is in between 18 and 60%. So what do? We interpolate using the interpolation formula. Now the formula which I've given before is A plus bracket A over A plus B times B minus A, which I define as A is a lower discount rate, B is a higher discount rate, small letter b. Capital letter A is the positive MPV with a lower discount, while capital letter B is the negative MPV with the higher discount rate. Okay, so let's substitute. So we said from what we are solving, our A, which is this, becomes 16%, our B is 18%, our capital letter A is our capital letter A is 214 and our capital letter B is 529. Okay, so we're going to substitute. So our A is now 16. So we have 16 plus bracket opens. Our capital letter A is 214 over A plus B will now be 214 plus 529. Please, when solving, now it is not that because it is negative here, you will not put negative here. No. Okay. So when it comes to this point, you don't include the negative sign. So we'll have times B minus A, that is 18 minus 16. So if we solve down, we have 16 plus 214 divided by 214 plus 529. Now if we add that, if we add 214 0 shift number 214 plus 529 is 743 times 18 minus 16 will give us 2. Okay, so if we solve down, we'll have 16 plus now 214 divided by 743 times 2. You have 0.5, approximately 8. So from here now, we now have 16 plus 0.58. If we have plus 16, it will now give us 16.58%. So 16.58% is our internal rate of return. So it is this rate that will give us zero NPV. Okay, using the interpolation formula. So thank you for watching. And sure you like, comment, share, and subscribe to this. Now I know why treating this, some persons might be confusing how do we get our rate. Now there's no problem. We've done a video on how to get this rate, on how to see how we calculated this. Now if you have not seen that video, this video popping now in my YouTube, watch it now. Thank you very much.